All right, I suppose we should start now. In this age of Zoom calls starting right on time, it's kind of strange to wait too long. We have a consensus of people on board. My name is Michael O'Flynn. Welcome to the VEC 2026 Outlook webinar. My partner, Arun Mehra, is on screen in the little box there. He'll be speaking shortly. And our lead analyst, Abhishek Salunke, might be joining us from Mumbai later on in the call as needed. In terms of our agenda, I'll review performance very briefly. This call isn't intended to be an infomercial. Before Arun digs into why India underperformed last year and how the Indian market might be poised to deliver some really exceptional returns in the next 12 to 24 months as a result of that sort of healthy pause. And we hope that that performance is led by some of the companies in our portfolio, which we'll walk through later on in the call, including a very interesting Indian defense sector play. The key topics that we'll be covering that Arun was speaking about are on the screen right now. But before we go into the agenda for the day, let me just walk you through what happened last year. Our flagship strategy, the VEC Indian Special Situations Fund, fell about 3.8% net in US dollars last year. We meaningfully outperformed our benchmark yet again. You can see on this chart, it's the fourth time in the last 5 years, the second time in the last 4 years that we've done so during a down market, although not to the same extent as we did in 2022, as you can see here. That said, as a team, we never feel good about a year when LPs lose money. And even though this is a long-only strategy and these outcomes are often hard to avoid, we will try to do better in the future. Before the call, Arun and I debated the word that best describes our performance last year, and we came up with the word satisfied, which I suppose is appropriate given the fact that the overall Indian market environment faced some headwinds. On the earnings side, from the macro level on the MSCI, the large cap side, and especially with the currency, the FX, entered the year at about 85 to the dollar and finished December close to 90. So that 5% FX headwind, although we don't hedge the currency at all, it is something that you should keep in mind when you see our down 3.8% number for calendar year 2025. Again, that's a US dollar figure. We actually made money in rupees, although it doesn't really matter for our offshore investors. In terms of stock selection, consumption didn't work out as well as we hoped. Last year, the whole idea of consumption picking up in India was a main thing we've been driving for the past 12 to 15 months. It's starting to turn. Arun will expand on that soon, but hasn't done so on the pace that we expected. And several of the names that we hold in our basket of consumer companies that we've spoken about a few times over the last few quarterly calls failed to deliver. But having preserved capital pretty well, especially for a long-only fund, we feel like we are really poised to fight on our front foot, as they say, as we enter 2026. And we really, really like the portfolio of stocks that we have. In terms of a longer-term perspective, our trailing returns, our CAGRs, they all look great. And it's nice to see our 7-year numbers start to come around, which hadn't been the case before we started to get past the Indian financial crisis of 2018, 2019, when we changed our strategy for the better. We're designed to produce 20% net returns in US dollars every year. So we're delivering on that, and we believe we can do that going forward. On a final note, before I hand the call over to Arun, note we started last year at $88 million of AUM, and we finished just a shade below $130 million AUM. So as a firm, we have great institutional momentum, although we'd love to see more assets come into the international side of the business. The domestic side has been a real story supporting the market, both with VEC as a microcosm and for the overall market in India. As a reminder, we'll open the call for Q&A after Arun's comments are concluded. You can use the Zoom function, or you can just email me your questions. So with that, I will hand the call over to you, Arun. Go ahead.
Thanks, Mike, and welcome everyone to the call. I wanted to step back a little and talk about what has happened to the market and what has led the economy and the market to where it is today, and discuss all the developments that have taken place over the last couple of years, and that will help you understand the potential going forward. Now, keep in mind that India has been a stock picker's market, and I think we're back into that zone. If anything, there are a lot more choices today, given the volatility that we continue to see. Now, in order to understand what happened in 25, it's better to roll back a little post-COVID and understand what happened to the economy. So not only was liquidity completely opened up, you had a significant policy response, and that is what saw a very strong growth along with a very strong boom in software services, which led to very high inflation getting into 23, along with unsecured lending, which was starting to go out of control. And for people who've seen the Asian crisis a long time ago, this is exactly what had happened a very, very long time ago in Thailand and Indonesia and so on and so forth. But the Indian Reserve Bank has always been very conservative, and the previous RBI head did exactly that. They started to pull back the liquidity. They started to pull back the rates and started to put more restrictions on banks, NBFCs, as well as the host of fintech startups that were giving unbridled loans. And there was a point in time where you had let's say a gig driver or a rickshaw driver taking 5 loans. So I think what the Reserve Bank did was they tightened to the extreme in 24, and to the point where liquidity became extremely tight. And so not only did inflation start to come down in 24, at the same time, government capex, which had supported the market in 23 pre-elections, which was single-handedly responsible for a host of sectors to have done well, started to get pulled back because the government wanted to normalize its fiscal deficit. So you had two events. You had liquidity being pulled back considerably in 24. You had a government starting to focus on fiscal deficit, which started to cut capex, capital expenditure, which obviously showed up in a fewer funding, lesser liquidity, lesser growth in the core sector of the economy. And that's really what played out when you saw financials underperforming, consumer underperforming, but you had select pockets of capex and infra which continue to do well, and select companies continue to do well. Now, what has changed from there is, so if you actually look at what has happened after that, is that by the time the new governor came, inflation was starting to get to fairly low levels. You have a stabilization in earnings. So the Nifty earnings, if you look at the broader market, they've started to stabilize. In fact, you're starting to see the first signs of it moving up. And now when you look at inflation today, post what happened in 2024, 23 end and 24, inflation is now negative. And, I've never seen inflation that low in India. And so it's kind of interesting to see how inflation is completely gone off. And this year, they've started to reverse everything that they did in 23, 24. So to think about it, you had a phase where massive liquidity, massive capex, unbridled lending, problems starting to occur, to extreme control. So you went from one extreme to the other extreme, where you pretty much starved liquidity, financials underperformed massively. You started to consolidate your fiscal order, fiscal book. And that's what happened in 24, leading up to 25. So while we can argue and say that, look, India didn't have the AI flavor, India didn't have had other issues with the US trade deal and so on, but the fact of the matter is that you have a macro situation which has gone from extreme liquidity constraints to a point today where this last year or 25 has been a reversal of that extreme again, where you're now opening up the economy. So what are we doing? They started by giving income tax rate cuts. You've had 125 basis points of interest rate cuts. You've had an opening up of the banking system. They're allowing a lot more foreign exchange borrowing. They've loosened the risk weights. So you're now into the zone where they want to encourage growth, and liquidity is in abundance. Inflation is at an all-time low. It's significantly below RBI's. In fact, WPI is negative. And even if I look at core inflation is more like 3%, but that's primarily because of gold. Gold is part of core inflation. So food inflation is very, very low. You've had a great monsoon. And that's what you're starting to see. The policy is completely aligned now. They're pushing for growth and liquidity rate cuts, followed by the GST rate cuts, where consumption is now being given a major fillip. So you had income tax cuts beginning of the year. You had massive policy response from interest rate cuts. You've had massive doses of liquidity, easier borrowing externally, much more looser risk weights to encourage lending, coupled with the first signs of free trade deals, whether it's the UK, New Zealand, Middle East, even though these are smaller ones. But the fact of the matter is that the growth and the push is starting to happen. Now, keep in mind, the fiscal deficit part is still being controlled. The government is still controlling its fiscal deficit, and hence you're not going to see a big capex like you saw in 23, right? But that should not discourage the growth in the economy in any way. If anything, the rest of the economy is continuing to do very well, and you should see close to 7% or above in terms of real GDP growth. Now, why did equities pause? Equities paused in 25 for several reasons. India didn't have the AI flavor, if people say that, but more so, I think the earnings growth was weak in when you look at the broader or the Nifty market, but that's improving. Now, why is that? Why is the earnings growth low? You have nominal growth in the past was always about 13, 14%, because you had growth of about real growth of about 6.5, 7. You had inflation of about 4 to 5. So you always got very high double-digit growth, and that's what the market paid for. Now, what you've seen last year is that becoming more like 8, 9% because of inflation not being there. And hence demand has been weak. And that is what the reversal has started. So what we are seeing now is this reset where earnings growth will not only pick up going in this year, given the liquidity boost, but you're also seeing valuations which are becoming much more attractive. And even in the broader market, which is obviously for us as a fund house is driven by finding those 3, 4 stocks a year. But on a broader range, you have valuations that have corrected and are getting more attractive with the volatility that's continuing. Now, if you think about currency here, that's the other point that is interesting. The currency 2 years ago, if I look at 23, was about 2023 was about 83, 80, little above 83 rupees, and today it's 90. So, historically, a 3 to 4% devaluation is the norm, but it never happens in a straight line, and you tend to have years where you have a very strong flows or limited flows or some event or the other. And this time around, the currency did extremely well in 23-24, as all of you will remember, when the Asian currencies and other currencies were declining versus the dollar, the Indian rupee held up. And it was partly RBI, it was partly the flows, but that's what is really reversed, given the weakness in earnings, given the FI flows, given the trade deal issues. So what you have is a reset of valuations, you have a reset of the economy towards significantly pushing liquidity and growth, as well as you now have a currency adjustment, which is pretty much coming to an end. And so you have a lot of these things aligning. Now, one important thing that people need to understand about the Indian market now is if you go back in history, the Indian market worked on foreign flows. Money came in, foreign people bought, market went up, they pulled out, market dropped. Now, that's no longer the case. Today, the stopgap is domestic capital, and domestic capital is now very significant, and it's increasing by the day. You have a steady SIP flow or systematic investment flow of more than $3 billion a month. And so domestic capital is growing very rapidly, is becoming very large in size. And today, the price is being set by the domestic investor, not by the foreign investor. So you can see the flows. The foreigners are pulling out, but the flows in domestic are huge. And obviously, there's been a very strong supply of IPOs, and a lot of these technology-based IPOs have valuations that we can't make sense of. But there are buyers, and people are taking that over. As a rule, we don't do IPOs period, unless, of course, something which is very attractive and not overly priced. But domestic capital today is the cornerstone of the market. So you're not going to see a market melting down even if foreigners sell. And that's what you've seen multiple years of the last 5 years. The market will correct if domestic investors sell. And that's a big, big change, keeping in mind flows that are happening in the market. So you have an environment where corporates are flush with cash. You have excellent banking regulations opening up. You have very low NPAs. Rural growth is picking up. And there's significant push from a policy perspective on the manufacturing side, aerospace, defense, as well as increasingly the push towards nuclear energy. So when we think about India today and the market, I think a lot of things from a policy perspective are happening in the right areas, in the right space. If anything, this whole push towards manufacturing, the startup environment, what we hear today is, and this is across the board, talking to vast number of people across the technology sector as well as the startup space, is that if you go back in time, maybe 80% of all the IT engineers would head out to the West, and that's now halved. If anything, it's like more like 40%. So the build out, the venture capital, the focus on tech is it's one of the most active venture capital areas besides the US and maybe another country or two. So very vibrant ecosystem of startups, huge focus on technology, AI applications, and that's really what is the most positive thing here, right? Now, what remains now to be done is the US trade deal, and that continues to be an overhang with geopolitics the way it is. Now, how that plays out is anybody's guess, but the volatility that you're now seeing is more driven by geopolitics versus fundamentals. You have a growing economy, you have abundant liquidity, you have a range of tax cuts and GST cuts, which are giving consumers more money. And that should all play out from this year because it came to fruition last year. And if we look at the commentary of a lot of the consumer firms, especially the FMCG firms, they're all pointing to a decent December quarter. And again, even within our portfolio, we've had consumer companies, which were starting in new niche areas or low base or new industries have done very well. It's the kind of the discretionary side, which is kind of held back. So coming back again to before we talk about companies that we like and to give you a flavor of the sectors and kind of businesses we like, I wanted to mention a couple of things. So increasingly, even in our work, we're looking for companies which have IP. We are looking for companies that have technology-based advanced drug manufacturing. So the content of IP, the content of technology, the content of advanced kind of manufacturing, advanced drug, aerospace. These are all areas which are now emerging, and that's really where we're trying to look for even ideas. So with that, I want to kind of move into and talk a little about the kind of businesses and areas we like. Mike, you want to move to Nuvama? So one of the areas that really is fascinating and is a huge growth area is this base of affluent consumers that is increasing in India, and it's getting to a size where that market alone is significant. And wealth management is one of the offshoots of that. And this is a business that we've owned from the time of its listing. It's already given us 3x. And it's a business which is going to compound at 20-25%. And fantastic management. There's no need for capital. They're paying out the majority of their profits and dividends and compounding at 25%. And the best thing is that the penetration of wealth is so low in India, or wealth, professionally managed wealth, that the opportunity is just starting. And if you look at estimates, if you look at numbers, if you look at even the projections that the companies have, they're all talking about a tripling of just the wealth under management, under professional management. So this is again an example of how stock picking and specific opportunities are increasingly going to be important in India, where you're investing in businesses, companies which have clear runway for growth, don't require a lot of capital, and have huge growth potential going forward. And so if you look at a business like this, it's going to triple in, just the size of the industry is going to triple in 5 years. Now think about that, right? And here you have a company which is not only adding more relationship managers, using a lot of technology, and going even in smaller towns and cities where people who have sold businesses or are now coming out, the second generation that has studied outside or is coming back is increasingly interested in getting advice and help. So fantastic industry, huge growth. Obviously, we think that the stock doubles again in the next 2 to 3 years, and that's really the opportunity. So over a 5 year period, we would have made 5 times our money in a business like this. And this is a sign. This is again a sub pocket of the affluent industry that I'm talking about. The number of affluent households and the consumption that is being driven. So if you think about India today, you have to think about not only which part of India you're investing in, but also what's the growth potential in that. And while you have a rural economy and a large part of the population that is doing dependent on rural and is now growing, that continues to grow year over year. But you got to pick very specific pockets. In the affluent India space, you have companies that are catering to different parts of it. And for example, think about the gold holdings, right? India, as of this data, is as of September 23, and it was a tad under $2 trillion. Now, if you look at the value of gold today, just Indian households will have upwards of 4 trillion in gold. And so what we are seeing is not only the numbers of affluent increasing to a large extent, but also their ways of consumption, their demand for services, the kind of services they want. And these are great businesses to own because you have large moats and large sizes, as well as earnings growth. So Nuvama is a perfect example of a business which will continue to compound and grow. And that's really what, again, to give you a flavor of the stocks and businesses that are available to invest in. Now, the second business that I wanted to talk about was a little different and more so in aerospace and defense. And if you look at this huge government push in localizing, in manufacturing, in pushing for defense technology to be manufactured internally in the country, this is an example of a business. And it's really interesting that this is a company which used to be a tiny company, and I had met them way back in 2005 when they were sitting in a warehouse and developing these simulators and so on. And that time it was a very tiny company, and obviously it was not investable. But come today, this is one of the few companies that has the IP technology and hardly any capital investment. We as a rule don't like big capital, big capex. We don't like big capital investments. Not only do they have a very lean balance sheet, but they have IP, which is, they are perhaps one of the very few companies in India, the only one besides a government company which is authorized to bid for simulators for anti-drone systems. And this is not the hardware manufacturer. This is the entire kind of software system and design end to end. So, this is another example of the kind of stock picking opportunities available where you have very high ROEs, very limited capital investment, and much more IP. And that I think is extremely important as you go forward and find stocks in India. So these are two different examples, but it kind of gives you a sense of what is available and what kind of businesses are available for the next couple of years. So if you go back and go back to kind of the overall, Mike, if you go back to the conclusion part to wrap up before I open up for questions, again, India has always been a stock picker's market. I think the valuations today, you're not, so if you look at Nifty, for example, Nifty trades at 20, 21 times now. You can argue whether it should be 18 or 17 or 20, but the point is you've always had 13, 14% earnings growth, whereas last year you had 8, 9% because of inflation. And nominal growth was extremely weak, and that's really what is starting to change. Um, in the broader market where we're searching, we have 1,500 companies, and we're looking for three, four, and but there's enough to choose. The valuations are getting more attractive, and again, it's no longer about market being cheap or expensive. You have pockets which are overvalued. You have IPOs which are overvalued. You have stocks which are very attractive, very cheap, and you'll have fair valuation. So the earlier model of boom and bust is no longer valid given the domestic capital, which is now a stopgap. And with an economy growing at 7% for the next couple of years, you have enough to choose from. And I think growth is coming back. The only thing left now is perhaps, which is creating volatility and hence a very good opportunity to invest in is the US trade deal and geopolitics, which is driving the volatility. Even today, the markets were very volatile. But I think that gives you an opportunity to buy some of these businesses even cheaper. So with that, I'd like to open up for Q&A, and then I can come back and wrap up, Mike.
While we're waiting for questions to be posted, there was one question emailed to me, and it was specifically to what you just mentioned, Arun. Do you have any companies in the portfolio that are sensitive to the ongoing U.S. trade discussions that might benefit from the conclusion of a deal?
Yeah, we have one holding which is extremely tied up. In fact, they have a manufacturing plant in the US as well, which is now running at full capacity. They make all kinds of fiber and interconnects. And if you look at Corning and CommScope in the US, they've obviously done exceedingly well. The stocks have done very, very well. And I think that
You're
is
talking
now
about
dependent.
Sterlite, correct?
Correct. And
Okay,
that
yeah, I'm
company is
pulling up an
now
old slide. Here, let me put up.
right. It's completely dependent on because they're not losing the customer, but they're now building and much more advanced products which have more margin to capture. And I think it's just a question of time. I mean, we've had insider buying in this business. I think the complexity of the products is changing for AI, DCs, data centers, and hence, the profitability of this business, the day the trade deal is signed, is perhaps going to shoot through, and it'll perhaps catch up very, very fast. So it's kind of holding fire, if you can say that, or holding ground. But this is the only one we have, which is directly exposed to the US trade deal.
Thank you, Arun. Let me check here. Thank you for an interesting presentation. You're welcome. Any questions, guys? While we wait for the shy to talk, just wanted to mention something briefly. Let me just flip back here to where we are currently positioned. Just tap through and then share. I can walk and chew gum, folks. So this is how we're currently positioned as a fund. We have 21 positions. The largest position is a company called Aether, that makes E2 wheelers. We've talked about it in recent newsletters. Probably our top performer, maybe that or DCB Bank last year, Arun. Largest 10 positions are about 60% of the portfolio. Active share, that means non-index exposure, about 95%. Very interestingly, the weighted average market cap of our portfolio today is at its highest I've ever seen. I've never seen it get through 1.5 billion. It's been edging up there, but it's kind of attached to the development of the Indian market and the fact that we've gone up the liquidity sort of spectrum a little bit over time as we're finding really good value with larger companies that bring with them more liquidity. And then the PE, I think, is very interesting. We don't look to buy cheap companies per se, and I've said this ad nauseum. A decade ago when this fund first started, we kind of prided ourselves on owning things below 10 times earnings, but we have good, strong growth behind the 18 times multiple that we have today, which is a sizable discount to small caps and even to large caps within India. Arun, any comments on there while I wait for the
Yeah, I have a
Ask a
question
question?
from Akshay talking about two scenarios. One
Okay.
where we buy oil from Russia, but only to satisfy internal needs without tariff being imposed, and another where the US really pushes a further reduction in Russian oil price. How will this
Yeah, we
impact
want to
energy
avoid that
costs?
500%
I
tariff,
think
right?
I think the market sold off today on the news of this 500% tariff. But again, geopolitics today is creating volatility, and at the end of the day, it's very hard to tell, Akshay, how this thing will play out. Because there are so many things involved, and you know, uh, the question really will boil down to what is more important and what makes sense for every country. And I'm not an expert in that, but um, it's just very hard to say. I think as far as energy is concerned, I think overall I don't see energy costs. I don't see oil prices shooting up massively under any scenario until you get a prolonged or a major war breakout across the globe. So, with that in mind, I think even if the Indian government has to forego a little bit to kind of do a deal, I think they will. But no one knows. I think we're just speculating. At the end of the day, we are buying businesses which have a clear runway for growth, simple, easy to understand. We got to see earnings growth of 2025 compounding, and that's really what we're focused on. And there's enough to choose with or without our oil. And if volatility makes them a little cheaper, I think the entry point gets even better.
Thank you, Arun. Another question coming in through email asking pretty generically, how do you see Indian equities performing in the coming year? To that, I'd like to add, in an environment perhaps when oil prices come down markedly, if this Venezuelan situation clears up and we get a lot of oil coming onto the market, if there's peace resolution in Ukraine, how does that possibly impact India to see maybe oil trading
Look,
45, $50 a
I
barrel?
I think oil is obviously, it's very topical and it's a point of discussion. But what people forget is that even when you had $100 and above in oil during the BRICS rally, because of earnings growth, market was doing really, really well. So at the end of the day, it's earnings growth. You're in India because of growth, and I think people are forgetting that you have an economy which is now almost touching 4 trillion. It'll be the third largest economy, and in the next 5 years, the kind of opportunities and the wealth that's going to be created is going to be a lot. And I think the Indian IT, if you look at, I think the retraining on Python is almost complete. I think the larger IT guys are ready for the AI wave. I think the adaptation and low cost usage will eventually come out of India. And what people forget is that earlier you used to have only IT outsourcing. Today you have so-called global capability centers or GCCs, and there are 2,000 global companies that have offices in India where they are not doing IT outsourcing, or they're doing engineering work, they're doing AI models, they're doing, one third of Nvidia is in India. So a de facto labor supplier, a de facto, on engineering, R&D, high-end work, all that is coming there with 2,000 global capability centers. So I think that's really what it is. It's a growth market which will eventually use AI to bring a much more improvements in productivity and cost. But that's what we're looking for. So we're looking for a market which is going to grow, and hence. So if you look at the return, I think the earnings growth should pick up in the larger market, in the larger cap space. If you look at our particular holdings, because we are very driven by specific triggers in our businesses and companies, I think the few companies that have kind of bided their time last year in 25 are getting ready for a host of big trigger points in this year, and we're extremely hopeful that we can continue our compounding in this year, just given the earnings growth expected and the trigger points that we have for our holdings.
Yeah, and I just wanted to speak to the slide that I put up on the screen here. If we're entering a new stage where earnings growth, the slowdown in earnings growth and the slowdown in GDP perhaps have stopped and we're starting to accelerate again and we're starting a new cycle, then this is certainly a great time to be involved in the small and mid cap space, which has produced, as you can see on this chart, some great returns over the years, both cyclically and then just as a whole. You're picking up several hundred basis points by going not necessarily to the smallest companies, but to the mid caps, which is really where we operate. We base our performance against a small cap index, but that small cap index is actually more of a mid cap index in terms of its average market cap size being a little bit bigger than what we are. So that's probably about correct for who we are as a firm. But if we're at the stage of one of these next up cycles, then there's some pretty good returns waiting ahead for investors.
There's another question on policymakers balancing the need for interest rate cuts with currency weakness. And I think I covered that earlier that, currency in India, just given the interest rate differentials, inflation differentials, generally tend to devalue by 3 to 4%, but it never happened in a straight line, Jason. So, what you've seen is 23 to now. So, over 3 years, you've perhaps lost 10%, which is about 3% a year. And I think the currency adjustment is coming to an end. And that's what we should see.
And we just had another one pop in there. I love it. This is great. In the old days, people would press buttons and have someone bring them on to the call, but this is great direct.
Yeah, absolutely. Investors are getting more active. I think you have voting, you have legal enforcement, you have institutional advisory firms, proxy firms that advise investors. So the onus and the requirement is, and I've had, we've seen investors who don't see management performing, and in fact there was a pharma related company which had been taken over by a private equity firm, and they had bad performance, and you had investors kind of literally blaming the management, blaming these private equity guys, and it's a very well known firm, about how badly they were managing it. So I think corporate governance has come long way, and it's fairly robust. The institutional advisory mechanism is robust. SEBI is very stringent on requirements, and hence, it continues to get a lot better. Now, is there a lot of activism where you can actually take over and throw out management? That is not yet. I mean, you see signs of it. You see signs of people selling and businesses selling and paring down. But I mean, PE guys are active, but I wouldn't say that it's kind of reached levels of where it should be. That's an area where I think the market will continue to mature. But governance, stringency, regulations, I would give very high marks to SEBI.
There's another one I just got from email. I posted it there for you, Arun. Do you see that Arun spoke of the shift from international flows to domestic flows? How has that affected trading activity at a sector or stock specific level?
Well, I mean, the marginal buyer, the domestic capital is what is driving. So, if foreigners are selling, it's getting absorbed. These IPOs that have come, you've had private equity guys selling and taking the money, right? And so, there was a point last year where your net FDI was perhaps flat because you had some FDI flows, but you also had people pulling out money, right? Does it impact flows, liquidity? Generally, what I've seen is that, in markets like these, the depth in the market is not there. So, like, for example, today you had, because of this 500% tariff noise, the market sold off and some of the exporters sold off. And when I was looking at the volume, I mean, these stocks were down 7, 8%, 9%. But when you looked at the volume wasn't significant at all. So the point here is that, look, shorter term, there's going to be a lot of noise, and hence stocks will go up and down. But if you want to buy it in size, you'll have to very slowly accumulate it. So I don't think trading activity or sector specific flows matter, because these kind of opportunities give you time to slowly accumulate. But this is not high volume selling.
Yeah, and I'd like to add to that. I'm popping up a chart I had a friend run for me this morning from Bloomberg. We are too small to afford a Bloomberg terminal. So once we get an AUM up, perhaps. But the Indian market is worth over $5 trillion today. And it's quite relevant on the global stage. In a year like last year, I understand a lot of frustration from investors Pan-EM was up 30%. India was flat to down, whether it's small or mid caps or whatever, but it was generally flat. And it's, what's going to happen next? Is it relevant to international investors still? Absolutely is my reply. And those international flows will come back, especially for quality companies as growth reaccelerates. And hopefully people will start to identify the value in the portfolio that we hold.
And all the steps that have been taken with liquidity and rate cuts, and the growth is fairly robust, and the rural sector is doing really well. I think the focus on IP technology, the push on the venture capital side is very positive. And look, you had a 3-4 year very strong run, so it was bound to kind of catch up. But there are several trends and several buckets in a 4 trillion economy, which is growing at 7%. So there are enough pockets to choose. There are enough companies to choose. It's a stock pickers market. There are overvalued pockets. There are fairly valued pockets. There are undervalued pockets. It's a stock pickers market because it's no longer the depth and the breadth is starting to build in a significant manner, and also with a lot of IPOs and more domestic money coming in. And so I don't see that as an issue. I mean, at the end of the day, it's all about stock picking now.
Excellent. Thank you, Arun. And we're at about 40 minutes, so that's a bit long for a call. I'd want to say thank you very much for your comments, Arun, and to everyone who posed questions and everyone that joined us today. We appreciate your interest in our strategy. If you'd like some of the slides that I've shared, just ask me and I'll send them to you. And otherwise, we hope to speak with you soon in the new year. Thank you.
Thank you.
Yeah. Cheers, guys. Bye-bye.